So are we ready to go?
Yes.
We start?
Yes.
Yep.
Okay, sorry about that. Well, welcome everybody. This is a webinar which is part of the path towards the second Dolomite conference, and the sort of the overarching theme of the conference is a new hope for climate. This specific webinar is looking beyond ESG, whether to measure less and measure better, and what to discuss the mechanisms for steering private investments towards sustainability, green energy, and other initiatives that can make it possible to solve the climate crisis. Now, I'm Jan Piotrowski, I'm the business editor of The Economist, and I will now hand over to Francesco Grillo, who is the director of Vision Think Tank, which is the main organizer of the conference, to introduce the initial problem setting and the concept note. Then we'll move on to other people whom I will introduce in due time, not to take up too much time at the moment. Francesco, over to you.
Thanks a lot, Jan. You can hear me, can't you? Okay, good. Okay, Measure Better, Measure Less was in fact the title of a cover story of The Economist. I think was a couple of years ago, probably a little bit less than that. I think it was Harry Tricks at The Economist, and it is self-explaining. I will leave it to Irene from Politecnico Milano to better illustrate the frame that together with the students of the Master of Transformative Sustainability she elaborated. But the measure less, measure better is self-explaining. The ESG, environmental, social, governance indicators have been a very useful attempt to steer towards sustainability investments from companies, and yet they are probably too wide to really avoid greenwashing, and too cumbersome for small firms. They risk to become a bureaucratic sort of obligation. Few words on the Dolomite conference on global governance of climate change, and a few also guidelines, if you want, that will steer the entire debate. The attempt is to create a global platform for problem solving, which is not so formal like the debate within international organization, with which we are linking anyway, starting from COP28. So we will have 80 people in Trento and Bolzano. So the second edition of the Dolomite Conference will be quite bigger than the first one, coming from very different professional backgrounds and countries. The idea is to provide some significant contribution, both on the problem setting, so really better understand, better define what we are really talking about on the various big questions linked to climate change, including ESG. And number two, ideas. The ideal output that we envisage is the Dolomite Manifesto that we will deliver at COP28 in Dubai at the beginning of December is standing with a couple of ideas for each of the big questions, ideas that are new enough, pragmatic enough, but also visionary enough to indicate a direction. So having said that, I will leave it to Irene. Thank you very much, Jan.
Thank you, Francesco. Irene Bengo, our first speaker, is the Associate Professor of Transformative Sustainability at Politecnico of Milan, and she will introduce the concept note.
Thank you.
The floor is yours.
Could you hear me now better? I changed my PC. Okay. So
Much
thanks for the
better.
invitation. Not better?
Much better, yes.
Yes. Okay. Okay. So thanks for the invitation, and we'll start with also thanks to the two students, so Antonio and Elisa. Thank you very much for your support and your concept. So I have 5 minutes, so I try to explain you the idea related to the problem connected to how we can measure and manage the impact in general terms. So I think we are really leading a big revolution on sustainability and impact with the idea to align the different economic actors. So in this moment, it's not enough to minimize minimize the harm, but we want to create a real positive impact and positive value. So we can, one of main, I think, issues and tools, methods, approaches to support this challenge is the measurement system. So, and also the other very important concept related to the different actors. The idea starts with the financial sector, but I think in this moment it's also very important for the corporate and company sector and also for public sector. So during the last years, the ESG grammar, because in my mind the ESG is a grammar that we can apply in different ways, really has gained popularity. But in the same time, the big problem connected to the ESG is the idea that different actors measure in different way the three main dimensions of sustainability, so environmental, social, and the governance aspect. And after time, now we have the new European regulation. So you think about the green taxonomy and maybe in the future, the social taxonomy. We are waiting also for the new social taxonomy. These two new law drive the capacity of companies and also the financial actor to measure their sustainability and impact. But I think we need also to think behind the regulation, because this regulation as taxonomy, CSRD, try really to improve the capacity of companies and financial actors to show, to report the sustainability, but we need also we need also to manage this sustainability and impact. So it's a good news, the taxonomy, the CSRD, but also the non-financial reporting directive. But some challenges is open now. So, for example, I think there are three main challenges in this moment. First of all, because for me it's very important, why we can measure the environmental impact. We have the good metrics, the good KPI, a long story how we can measure the environmental impact. I'm environmental engineering, so very important for me. But we have a big problem related to the social aspect. Okay? So we need also to improve the capacity to measure and manage the social impact and governance. Other point is that if considering the story of ESG and the rating system to try to put in contact financial actor with the corporate actors, but the different agency provide different solution, different evidence. So there is a problem. And I suppose that the new regulation also will affect the capacity to measure and also try to align of different actors. So again, we need to improve the capacity to measure social impact. We need to consider the measurement system, the measurement approach, the measurement standard. We have a lot of different standards, but we don't have the gold standard. But we can consider only this practice as reporting practice. We need to consider this practice as tool to manage our impact, our capacity to create a positive value for the society to drive these big challenges. Other point is connected to the data, the quality and the accessibility of data. So how we can create a system that really show our impact and the capacity to create a benchmark system. So we don't have a standard, we have some law, we have some approach, but we have improved this capacity to measure and to align the different actors among the economic systems. So I conclude with the idea, please consider the measure as a management tools and not only reporting tools, and try the way to have the same value among social and environmental and governance aspect. And we think about the potential standard. We don't have a standard to measure impact, but we can share a sort of the approach to provide a potential solution, and also to try a way to support it, to improve the capacity to manage impact, considering, for example, the technology as enabler system to improve our capacity. I think I finished my time. I hope I will.
Thank you very much, Irene. That was all very laudably clear. So now we'll move on to our discussants, of whom we have 4, all of them very well versed in this subject or in various aspects of this subject. We have Professor Anastasia Zepapadeas from the Department of Economics at the University of Bologna and Athens University of Economics and Business. Barbara Kolm, who's the Vice President at the Austrian Central Bank and the Director at the Austrian Economic Center. Cliff Pryor, who is the CEO of the Global Steering Group of Economics Center. And Andrea Maffezzoni, who's the Chief Financial Officer of Monte di Paschi di Siena. Professor Zepapadeas, perhaps we can begin with you and your opening remarks.
Thank you very much, Jan, and hello everybody, and thanks for the invitation. It's a great event, and I'm very happy to be around this group. Let me start by saying that in applied sciences, and especially in applied economics, we're a little bit obsessed with measurements and metrics. I'm glad that Barbara is here, because I would say that the holy grail of central bankers is GDP and inflation. And then we measure these things and they get some signals and then they do something. Mrs. Lagarde, I think today, increased the interest rate just because the inflation predictions, the metric of the inflation prediction is such that it justifies this action. In the same way, when we move to the concept of sustainability, people at the beginning try somehow to can I have the other slide, please? This one, thank you. People at the beginning try to operationalize the Brundtland report about current and future generation and so on. And the work by World Bank and United Nations introduced this concept of productive base, which consists of the different types of capital, and one idea of trying to see whether we're sustainable, is this productive base is not going down as we move forward. In a similar way, the UN sustainability goals generated an incredibly large amount of indicators, again, which try to give some idea of whether different countries goes towards attaining these sustainability goals, no poor, better climate, better life in sea, and so on. And there's an incredible amount of indicators, and there is a procedure and a methodology of generating the indicators, then aggregate them to go to second level indicators, and so on and so on. In the same way, this idea of ESG, I can see it as a measuring framework. And as you see in the slide, I can see it in a following way, that ESG tries to measure corporate sustainability, which is a concept of sustainability at the micro level of the economy. But the interactions of the firms go to the higher level, and then at some point they are transformed to sustainability conditions for the economy as a whole. It's the same way that firms' decision about price setting create expectation about prices, and at the end of the day, we see inflation. So the question is whether these measurements are clear and whether they provide the correct signal. And here are the challenges, because what we try to do with ESG is we try to do different things. One is try to do whether a firm attains these objectives, good for the environment, good for the social, and good for the governance. But why we're doing that? What is the firm going to get out of it? Is it going to get to increase greenwill and get a better market share? Is it going to have a good green image towards investors and therefore attract investment and maybe increase profitability? So these are the issues that I think go behind the ESG. Now, what is the problem? And I will try to be as fast as possible. Can I have the other slide, please? Thank you. Well, now the other one, if it's possible. Yes, this one. Here is the idea. We have different firms, different institutions that they try to calculate ESG scores. Typically, they collect environmental indicators, social indicators, governance indicators for different sectors. Then they try to aggregate them, some methodology, some use aggregation through arithmetic mean, some they use geometric aggregation. It's a technical issue. And then the thing goes up and up until we get into the score. Sometimes this is the graph from one of these companies that generate ESG scores. Sometimes they reduce the score if there are controversies which are based on negative publicity. I think this is how recently Tesla got degraded in terms of ESG. So there is a problem of consistency, because different methodologies are used to measure the same thing, and then different scores coming from different groups are not compatible. So this generates a big confusion, and this confusion promotes greenwashing, does not give the right signal to the investor of why should the investor put the money to this firm with this high score, and eventually generates this confusion. And recent results indicate that the profitability of firms with high ESG score are not very different and cannot somehow indicate statistical significance of higher scores. So my idea, and maybe I can elaborate later, is that we need, maybe from an international institution like OECD or UN, some kind of a standardization so that ESG will be measured with a simpler way, and we have a compatible way of measuring these scores per sectors so that they mean a lot and we can use them as the right signal in order to obtain sustainability targets. In this respect, the title of this webinar or this conference, Measure Less and Better, I think reflects very nice this idea. And I will stop here. Thank you.
Sorry, I think I might have been on mute. 3 years into the pandemic and still having problems with the technology. Barbara, would you like to follow on from that?
Yes, thank you. Anastasia, thank you. This was brilliant. And I have to compliment the students, and Irene, thank you for supervising them on what you have sent yesterday or earlier, the Word document. It summarizes the things, and I think we have to look into what are the soft, because we mix up things with the entire ESG models. On the one hand, we have soft facts. On the other hand, we have hard facts. On the one hand, we look at microeconomy, and on the other hand, we look at macroeconomy. And then, as Anastasia has mentioned, truly, there is no consistent modeling at all. And the first thing that we need to fix is the definitions. And whether it's on the green finance issues, whether it's on the entire SDGs and ESGs, I see, at least in Europe, and I've mentioned that many times already, 3 different sets of definitions. The EU, the Commission, has a different definition, whereas the European Central Bank has a different definition, and Geneva, the UN, has another definition. So we are operating in thin air. So, and I fully support Anastasia's suggestion that we should have a standardization on that. And I am working on the Smart Sustainable Cities project, as you all know, on the ESGs as well. And we have created key performance indicators that are now standardized, and 18 UN agencies are using them already. The most recent UN agency that joined was the World Tourism Organization. So they are using these KPIs, and they are all within the framework of course, ESG. You can always add more, especially on economics, there is more, but also in social society, you can add 100 different key points. But this is a kind of a basic common denominator that we already have. But the big thing is that I would like to throw into the discussion is, who are in the end the beneficiaries of it? I mean, we have come a long way thanks to SDGs and the ESG discussion across the world. But there is one big problem. We are talking about different economic integrations. We're talking about advanced economies. We're talking about less advanced economies. We're talking about developing countries. And there we have a huge imbalance. So apples and oranges are totally different. But we all throw them in the same basket. And I think this would be the task also of our working group to kind of discuss that and suggest some clarities on how we can look into that. Maybe just even if we look into, okay, this is the developed world, this is the undeveloped world, and we find 3 different kind of differentiations, whether it's I would not go with GDP per capita, but we might find other economic measures that would help. And lastly, the problem of greenwash. This is a big issue, and we've seen the ECBs now finally, because of other problems that they need to fix and have not fixed over the past years, which were totally foreseeable, namely inflation, that they have stepped back a little bit from this entire green monetary policy, because I have always been of the position that it is not in their mandate. So they should concentrate on their mandate and not doing that, and let the green politics do the market, the banks, the institutions, but not the central bank. So I would stop here. But for me, the most important thing is not mixing soft and hard facts, and not mixing micro and macroeconomy. And this is what we need to detangle, because it's always driven by interest groups. And sometimes it's the lobbyists in Brussels, sometimes it's the lobbyists in Washington, and sometimes it's the lobbyists in New York or elsewhere who drive the agenda. And that's the biggest challenge.
Thank you very much, Barbara. Cliff, I'll hand over to you now. And now you're having COVID trouble.
Doing it too. There we go. So as I'm working with the Global Steering Group for Impact Investment, I have to, of course, talk about impact investing, which is more intentional, measured, managed, and reported. There's a lot less of it than ESG, but I'll add some more problems to the ESG one of which is the geopolitical differences. So in the USA, ESG is under attack from the Republican right. In the EU, it's a question of tightening up and rigor. And in Asia, it is the new shiny toy that everybody wants to have. So we have some problems there. We also have some issues which are surprises out of the value chain issue of the EU system. The EU system looks all the way down the value chain. The idea was that big companies in the global north would have many material issues to report on. And when you went down to the small companies and the small farmers and in Africa, etc., it would only just be a few areas. That's not what's happening. The entire burden of reporting is being lumped down into smallholders in Africa and Southeast Asia, and it is causing some very adverse consequences. So there are problems, but the world is moving towards impact transparency, and I would be more optimistic about what is happening, for example, out of the International Sustainability Standards Board's global harmonized standards. It's a slow process, it's step by step, but it's coming further and further. And then we have the work on impact valuation, which came out of Harvard. It's now a number of organizations, including the IFEI and the Value Balancing Alliance, which has been working with 20, 30, 40 major companies to understand how you can put monetary values on the positives and negatives of what companies do. So the question then, of course, is, will that be taken up by jurisdictions? Will governments endorse it? When governments see something which is a negative, something that is bad, a sin, tobacco, for example, alcohol, I've never seen a government that doesn't tax them. So if we see the negatives out of the ISSB and out of impact valuation, are we going to have the same thing there? And also, this impact valuation is can be a useful business driver. There was an example a couple of years ago now on this between Ford and Toyota. Very similar companies, very similar product ranges, but one was using a lot more carbon than the other. And what they took out of it was, okay, we have this is an immediate spur to action. We're spending too much on our costs. So what actually matters here? It matters that the future system works for people and planet. We have things like the just transition constructs about environment, socioeconomic and community voice on that. It matters that these things are accepted by the key users. So that's the financial systems, the regulators, and so on. It also matters that it's trusted by populations, and that's probably the tougher one. And so there's the question then about, do we have a hugely complex system, or do we say, well, actually probably 10% of the factors that we're looking at will give you 90% of the value. So do we go for that? And actually, in discussions with the big four accounting firms, the majority think that that's the way to go, the 10-90 approach. But then we can look at some other highly complex, very important and challenging systems, which are now very widely accepted. And an example of that would be the National Institute for Clinical Excellence in the UK, which looks at every new clinical pill or medical intervention, and it looks at whether it's acceptable in cost and safety. And when that was first introduced 20 odd years ago, there were whole howls of protest of people saying, are you saying that my sick son or daughter is not worth saving because it's not acceptable in cost terms? But actually, this system is now widely used across the globe. The majority of developed jurisdictions use something like the National Institute for Clinical Excellence. And that medicine is just as complex as finance. So equally complex, but widely accepted. So do we look at measure less? And I think that's not the way to go. Do we measure better? Definitely. We have regulation pressure, we have consumer pressure. There are new positive opportunities out of the developing system, and for our people and planet, it's necessary. So I think my sense is I would be more optimistic. I think using impact tools and the new ISSB, the impact valuation tools, yes, there will be opposition, but there's been opposition from almost all major changes in the world, and that we will come out of it positive. Thank you.
Thank you very much, Cliff. And the last but not least, final discussant, Andrea. Barbara, I see you want to weigh in, but we will have time for a discussion a little bit later on. This is the last of our opening remarks, and then we will move on to the discussion. Andrea? Thank you. Good evening to everybody. Happy to be there this evening. So one of the points that was mentioned by Professor Bengo at the very beginning was the alignment of interests among the different players. In this respect, let's say there are, of course, many ways to incentivize sustainability, and governments, public institutions can take the direct measures like carbon tax or adopt policies in this regard. But in EU, a strong focus has been put on a sort of indirect approach, like, and that also was somehow mentioned before in previous opening remarks, an approach that has financial intermediaries as multipliers of the, let's say, public objectives somehow. So you have, on the one hand, investment companies, and that was mentioned, like there are asset managers investing more and more in ESG compliant companies somehow. And the reason why they do that is that, on the one hand, somebody might think that there is, in the long term, there should be a better performance of ESG compliant companies. And this is, let's say, one potential explanation. Another explanation is simply, if you want, a marketing explanation, meaning that there are more and more investors that want to invest into ESG compliant products. And this is, let's say, one angle, like investment management. The other angle, the other multiplier, is banks. And banks, basically, I mean, the angle why banks are a multiplier is related to the fact that the regulator and the supervisory authorities
ask banks to manage their medium long-term risk. So the underlying concept, the underlying assumption is that if your client has transition risk and you grant a loan, then the default probabilities increase because, for example, it is an oil company and then the business will dramatically change in the future, or because your client is a factory in a territory that is subject to floods, for example. And so, by regulating and supervising banks, the public authorities can somehow make sure that there is a general drive towards sustainability, because banks will tend more and more to lend according to certain criteria to manage the transition risk on the one hand, and in other cases, such as for example the case of most Italian banks, because they've taken voluntary commitments, like in the context of the Net Zero Banking Alliance, and for example ourselves, we set certain targets related to environmental targets, and we published them in August. So in this way, there is again a multiplier effect, because by regulating a limited number of entities, you can have an impact on a much larger number of companies. And I think that this is pretty effective. If you want, the issue of what can be improved is, on the one hand, yes, measurement, meaning that in order, let's say, to, as a bank, to assess my portfolio of companies and to optimize my loan portfolio in order, let's say, to minimize environmental impact and pollution going forward, I need to have a solid database. At the moment, this is not the case, meaning that there are few data providers, and the provision of this data is quite expensive, and so this does, on the other hand, not ensure the ultimate effectiveness of my intervention. So this is one point, and the other point is that let's say this approach is let's say mainly driven again by sort of moral suasion. So what might further incentivize players could be a sort of virtuous circle, so that let's say the minimization of my transition risk is recognized, for example, in capital absorption, and this would further incentivize players to implement let's say medium and long-term approaches towards reduction of the environmental impact. So I think that this is let's say a relevant point, because this is how in particular the EU framework is based on, and this is something we should focus on our discussion to think about potential ideas to further improve sustainability going forward.
Thank you very much, Andrea. I was going to go to the students next. However, I know that Barbara must leave early, and she would like to weigh in. And I think with regard to something that has been said. So, Barbara, I'll hand it over to you.
Thank you very much, Jan. Andrea, thank you for bringing in the private and retail side on that front, especially with banks, with all the regulation going on. I wanted to add two more things. After all, the entire ESG process is work in progress, and it's a constant reshifting. And the second point I would like to make is, next week and the following in New York, the SDG revision processes starts, and all the UN entities will report on how far they have come with their respective SDG goals, and without predicting anything. And as we economists, we should not do that. But I think we will kick the can down the road for another while. So the 2030 goals will not be met. We all know that we don't meet them, so we will not meet the 2050 goals, but we will go even further down the road with the excuses that will be made for various reasons. And so nothing is set in stone or carved in stone. And I think flexibility in the Italian way is, I think, also needed on that front, and a constant adaptation or adoption to the needs is also needs to be considered. Sorry, I had forgotten to say that, but I hope it adds to what everybody else has had in mind.
Thank you very much, Barbara.
And apologies if I need to leave early. I'm in Berlin on a conference on technology, and we were all dealing today, discussing net zero all day long. So sorry.
No problem at all. I will now hand over to our two students who have been helping with the concept note, and maybe to get a little bit of their preliminary feedback, and maybe some questions that they might have at this stage to the speakers. So Lisa, perhaps we can start with you.
Okay, sorry, I almost made the same mistake. Yes, thank you very much. I think it's very hard to compete with all of your very great ideas. So I think I will rather add some bit of complexity to the subject. Maybe I'd like to reply to what Anastasia said about the confusion that we have today with ESG indices, which I completely agree with. I think investors today kind of over-rely on ESG indexes because they are pretty simple to look at, but it's true that there is a real divergence between these different indices and the measurement methods that companies have. So the logical solution will be to find an harmonization between indices to increase comparison between companies of the same system. But my question is how exactly feasible would be to develop a common measurement method? Can we really develop today a consensus on a global consensus on measurements? And maybe to take back what Cliff said, where he suggested, on the other hand, to not think about decreasing the indicators that we have, but rather develop more efficient tools to keep everything that we have today, but do it better. I don't know if my question makes sense, but if we have these two solutions, what would be more time-consuming and cost-consuming? Reducing indices and trying to develop a common system, or develop better tools?
Thank you, Lisa. And I'll take Antonio's remarks as well, questions, and then put them forward to the discussants, perhaps with a little bit of a twist from me.
All right. First of all, I would just like to thank all participants, all discussants, for their insightful input. So far we've been talking about ESG. We've been saying we've identified the issue with the divergencies, and so far we've said it all about measurement divergencies. What one of the papers that Mr. Anastasia has kindly shared with us also points towards other divergencies the contribution of other factors which lead to divergences between the ESG ratings. So we not only have a measurement divergence, we also have scope divergence and the weighting divergence. And to me, it seems clear there's a mountain of work to do before we can finally develop a harmonized ESG index, which can, let's say, fully align the interests of the different actors towards sustainability. And there's also a clear urgency because, you know, with the next generation being more aware of sustainability, there's a higher attraction, there's a higher appeal to ESG investing. And among other driving forces, obviously, what I've been having in my mind is, well, sure, there's an urgency to overhaul the ESG framework entirely. There's an urgency, but there's also, like I said, what seems to be a mountain of work. If it was easy to develop a harmonized ESG index in the first place, it would have been here. It would be exist. We will have one already. But I've been comparing in my head towards other incentives, towards other mechanics, such as carbon taxes, actually. So to me, it seems like carbon taxes, theoretically, it should be here already. It's something that's free from political influence. It's a market tool. It's a market-driven approach. So earlier with what Mr. Anastasia said as well, with applied economics, applied sciences, to me it seems like perhaps we should consider prioritizing carbon taxes instead of prioritizing overhauling the ESG index, because who knows how long that might take. Now, of course, there are also other barriers to the carbon taxes. My question is to the discussants is, which should we consider prioritizing carbon taxes instead of trying to salvage what seems to be an incomplete system, which is the ESG index?
Thank you very much, both. Those were both thought-provoking questions, and indeed, I had ones which are quite similar and related, which is, so Lisa asked about the feasibility of common measurement, and Antonio mentioned the problems with scope and weighting and divergence, and that is something that I have been racking my brain with, and that is when you try to combine the E with the S and the G. Values come into play, not just measurement, as values as in sort of moral and ethical values, because people will value the E. Some people will value the E more highly than the S, and others will value the G more highly than the E. And coming to a global agreement on the exact weighting that each of these, and within them, each of the particular subdivisions of the E, the S, and the G, is, I think, basically a lost cause. I mean, that to me, if we wanted to create a single overarching a metric that everybody would agree on, is, I mean, I find that incredibly unlikely. I also find it unnecessary because it seems that if you let the market mechanism work, you could easily imagine that if we actually could measure the E, the E in various ways, the S in various ways, and the G in various ways, you could imagine a world where people would be able to pick or weight their own baskets, create a sort of, an ESG ETF where I want 80% going to the E, 5% going to the S, and 15% going to the G. And you could also pick and choose between the various sub-segments of each, which is what a lot of us do when we invest money anyway. So this is something that people actually do, and ESG is about channeling resources to the sort of things that we, to the sort of things which we value as consumers, as citizens, and as investors. And so my question is whether sort of disaggregating is not the way to go, rather than standardizing. and because that is something that people are already familiar with, that will not require some sort of global consensus, and that can be introduced, in fact, not as one single launch, but progressively as we get better at measuring certain things. So that's my sort of question / provocation to the panelists. Barbara, again, because you might need to be you might need to leave early, I'll have you go
finally,
first.
This will be my last intervention, but as a good journalist, Jan, you provoked all of us. And exactly so. But if ESG is about valuing resources, it's totally subjective. And then, we have our issues with subjectivity and objectivity and the kind of the Popperian case, and we go back to the methodology of sciences. And that's the question, do we want that or not? Or do we leave it as what it is, a marketing tool for certain people or other people? And this is why I made this big divide at the beginning: soft facts, hard facts, micro and macroeconomics, etc. So on the right hand, we have people who look at it from a neutral way and try to look at it with KPIs, and the others look at it from the value issue, because the values that we maybe in Europe share could be totally different or are totally different, not could be, but they are different in China or Latin America or elsewhere in the world. And this is the issue with subjectivity and the problems that I don't think we can sort them out because we are too complex as a humankind. But we have to put it at least on the table in a transparent way. And this is what is lacking right now. It's not transparent. People claim it's universal, and it's not.
Thank you, Barbara. Anastasia?
Thank you. Apologies for leaving early. I'm at another conference.
It's very, very kind of you to actually, give us a little bit of your time and attention, which is clearly in high demand. So we appreciate it very highly. Anastasia, is over.
Yes, thank you very much. Well, great questions from all of you, including you, Jan. Let me start with carbon taxes and ESG. ESG is not an instrument for climate change. ESG is just a reporting framework. Climate change will be solved, if it's solved, using fiscal measures. I'm sure that Barbara agrees with me, not monetary policy, which will be either carbon taxes or emission trading system or payments for ecosystem services to reforest and so on, not with ESG. I have in front of me a very recent paper by the Harvard Business Review that says ESG investing isn't designed to save the planet. So ESG is just a thing that measures and gives us information. It won't solve the problem. The way that when we measure inflation rate, by measuring inflation rate, we don't solve the problem of inflation. We need to increase interest rates. So this, I think, should be quite clear. The question is whether ESG can provide good information for the objectives that it's targeted, whether it can provide good information about whether firms do what they're supposed to do in protecting the environment, and whether provides good information for investors to invest in green firms. And for my opinion is that the way that the system is now is not doing it. I agree with Ian about ESG, but even within E, within S, and within G, we're going to have the same problem because we have lots of indexes and we need to weight them. And even if we found the correct ways, we need to find the techniques to aggregate them. These things can aggregate it with arithmetic techniques, with some kind of a CS function, economists know about them, or geometric techniques. It's a technical problem. So we need to standardize. That's why we need to standardize. Take a sector, decide a few indexes, indicators that represent the sector, and then try to agree on the weights and get something out of it that will provide information which will be not complete information. The final thing that I want to make is that ESG suffers from verification. We don't know whether the data which are collected are reliable. I'm coming from mathematical economics, and in some type of mathematics, there is a set of what's called verification theorems. With these theorems, we try to understand whether solving a problem with a specific object mathematical, the solution is what we're trying to find, and not something else. In the same way, the reports and going into the company about and trying to find out what data they give us, these data need to be verified that give what they're supposed to give. So I think reducing the number of indicators is a good idea as long as we agree, and that's why I mentioned in something that has international reliability like UN or OECD, to agree on a certain set of indicators, either for E, S, or G, and then do the weighting and the aggregations. That's from my part.
Thank you, Anastasia. Cliff, I think your hand went up next. You're muted again.
Not again. So I look at this from the other way around. If we don't take externalities into our cost base, if we don't recognize, the financial cost of the damage that's being created, basically our planet and our civilizations are doomed. So this is rather like thinking of the moonshot. There is no point in getting halfway to the moon. You've got to get there and back again, otherwise you're dead. So we have to work from the premise, which system is going to deliver this? It's not a question of whether we should or can. We have to. And it won't be perfect. It needs to be perfect. It needs to be close enough to perfect. So is ESG is a long way from a decent impact valuation system, but what we will need is some kind of impact valuation approach, a measurement approach. And then the second thing about, is it just the E? Do we also have to think about the S, that in particular the societal side? I mean, what we know about this, and we have seen in so many countries now, is that if there isn't a sense of social justice around climate change activity, there's a rebellion and it doesn't happen. So we have to find mechanisms. Now, they may not be the same mechanism, and I very much accept what Anastasia has been saying on this. There are, however, many other systems which are as complex as the ones that we're talking about now. Actually, local finance is one of them. To be honest, trying to repair a modern car would flux most people. So we are living in an age of systems where we don't fully understand them. Only a few, professors and super experts understand them. But we manage to do it. We manage it in healthcare. And that is just as sensitive as this. So yeah, take the externalities into our cost. That's an absolute must. Which are the measures? Which are the systems that would land us in the right place for the E and for the S? And I'm less worried about the G, to be honest.
I never quite understood why the G was there in the first place, but we can discuss that later. Andrea.
Yeah, thank you. No, just quick comment on Anastasia's comment. Actually, I mean, first a general comment, meaning that we're discussing about ESG, but the let's say, the event will be about the global governance of climate change. So probably we should focus on the anyway, and then we can discuss about the S and G. But apart from that, I tend to agree with Anastasia that, of course, ESG will not save the planet. But again, I would distinguish from the case of companies that are more or less invested because they are better or worse under certain ESG parameters, which is one case. And yes, I agree that the impact would not be meaningful. From the case where a banking sector is reducing by 80% financed emissions, or it is increasing by 40% green loans to finance transition. Probably this will not save the planet, but I think it will have an impact. So I would like to just highlight that.
Thank you, Andrea. And Irene. We're having trouble hearing you again. No. I think technical problems got in the way of that. Thank you so much. I think we're running out of time. One thing I'd like to chip in from my end at the very end, just again as a sort of another provocation or maybe a sort of question to this very interesting discussion, which we will continue in the run-up to the Dolomite Conference and at the Dolomite Conference. When you think about the three elements of ESG, the E, the S, and the G, there is a sort of an interesting difference between the E and the other two, and that is that the S and the G, they have self-interested advocates within companies, and you have mechanisms which those advocates can use in order to get their way. So the S is the labor market, where you sort of have, there's sort of obviously labor markets aren't perfect, but there is a way to set the price of labor. You have labor unions, you have, all manner of regulations about how workers ought to be treated and so on and so forth. On the G, that's basically shareholders. And they too have tools, and they are represented, and they have ways of eliciting the sort of things that they want from companies. For instance, by putting the people on the board and firing the CEO and so on and so forth. The E does not have that. E does not have an advocate, and E does not have a market mechanism, unless we have, well, we do have some emissions trading schemes, but they're limited, and we obviously don't have all too many carbon taxes. But we do the E, and that makes E very distinct from the other two. And again, that's just a thought that I want to throw out there as a differentiator, and why focusing on the E, which, as was rightly pointed out, we will be doing by Andrea, we will be doing in Trento anyway. Something to think about in the next couple of months, a couple of weeks. I'm also thinking about it very deeply. I will hand over to Francesco, maybe for a final word, because I think we're running out of time.
Yeah, thank you very much, Jan. It has been a great discussion. Let me just say two very small things. Well, number one, I need to say something now nice about a dinosaur that we have been talking about. It's the GDP. Anastasia mentioned GDP, but GDP has got still the luxury and the advantage of being a measurement that everybody, well, more or less everybody understand what are we talking about. Notwithstanding all the limits that even Simon Katznets mentioned since the start. So yes, I think that Cliff said we need to measure better, not measure less. I partially agree with that. So it would be good to have a debate on that, because if we really want to have customers, if we really want to have financial analysts, governments to use indicators, we need to reduce complexity. We need to reduce complexity in a big way. So probably, yes, we also need to measure less. We need to go for key performance indicators. I would be very happy if we save this quote unquote provocation of dividing the E from the S and the G, and probably, tackle the three problems with three different methodologies. I very much think that Jan is right when he thinks we need to disentangle, we need to disaggregate. I would say that probably we need to make the black box less black and have really people to understand what is in the black box. No, and this is a question to be discussed in Trento. So. There's been a great discussion, and I really encourage the students to push forward, to be provocative, to even dare to be radical, but also to start think about some ideas that we can put forward. So thank you very much. Great discussion.
Thank you, everyone.
Thank you.
I will. I'll just like to say again, thank you to all the discussants. Thank you to the introducers, to Irene and Francesco, and obviously to Lisa and Antonio, the students. And thank you to everyone else who attended. We will continue this interesting conversation in the weeks to come.
Thank you.
Thank you.
Thank you. Bye bye.